Good evening, everybody. My name is Dr. Rory Deverell. I'm a commodity risk manager with INTL FC Stone, based in our Dublin office. It's September 2017. This is part of our risk manager series, and this video goes with our H17-02 slides, constructing an agricultural volatility index and what it can tell us. As per usual, please take some time to look at our disclaimer. If you need to pause this video to do so, please do so. So what were we trying to achieve in this video? What we're trying to achieve in this analysis is essentially meet the same objectives of the SP500 VIX, or volatility index. Trying to achieve the same things as that does. And to give a bit of a background, the SP500 VIX is it's a look at the options market and using the information that options market gives us to get a gauge of market sentiment in terms of certainty, price risk, volatility going forward. So what they do with the VIX is they take the options market for various equities within the index itself, and they look at the implied volatility of those options, and from that you can take a weighted average and determine the level of uncertainty in the market as priced by the options. So it would go along the lines of, if the VIX is high, that means volatility, or the expectation for volatility, is high, and some people will call it the fear index. So if the VIX is high, there's a lot of fear in the marketplace. So if you look at the long-term history of this volatility index for the S&P 500, you can see we're in a period now of extremely low volatility, implied volatility, indicating a certain level of calmness in the market, a lack of fear, so to speak. So, and that helps, is helped. We can explain that to some degree when you look at the S&P 500 and the Dow Jones. They're making their gradual and consistent moves higher without much gyration up and down in the price. The expectation of the options market is that basically to persist. It's an expectation, it's not a guarantee or anything like that, but that's what the options market are pricing in at the moment. Another interesting point on the VIX is when you seasonalize it for a calendar year. I mean, there's no particular trend, there's no particular seasonality to it. You can get a spike in volatility at almost any period in the year. So there's nothing really to point to in seasonality terms. Now, when we move on to constructing an equivalent agricultural volatility index, the approach we took, we had to look to the Chicago Board of Trade. That's where the volumes of options were greatest, and it's a generally well-recognized source of corn, wheat, and soybean prices. So when we constructed our volatility index using the option market over there, you can see over the long term we're in actually quite a similar period, let's say, as the equity markets. That is, volatility is really low, or relatively low, indicating a certain calmness in the market, and there's not much fear going forward of how prices may gyrate one way or the other. And again, it's kind of like that steady sideways to lower grinding pattern that we're getting in the market at the moment. It's been reflected in the options market, and the options market are indicating that that's what people and traders expect to happen going forward, is this grinding sideways to lower pattern. And you look at the fundamentals of supply, there's no particular shortage of soybeans, corn or wheat, and the options market are pricing that supply outlook essentially. Now, what's interesting is when you seasonalize our agricultural volatility index, there is quite a distinct seasonality to it. We get a peak in volatility in the June, peaking in July window, and then it tends to tail off into August, September, and bottoming out in November. That's the typical pattern, and it's quite, especially in years where there is certainty of supply that's the typical pattern. It makes sense that we get that peak in volatility within that window. It's the period where the northern hemisphere crops are defined in yield terms and in quality terms. And this year has played out very typically. We got a spike in volatility in June and July, and now we're tailing off. And in fact, we're at the lowest level of implied volatility across these markets over the last 10 seasons. So it's a period of particular calmness, a particular ease at which the market is viewing the future of grain and oilseed prices. Volatility, as I mentioned, tends to bottom out in November, but then we tend to push a little bit higher into December, January and February, and that's our second window of where volatility and uncertainty tends to push higher. And that again makes sense when you look at the southern hemisphere and the role of Argentina and Brazil. And I think as they expand their supply and become more and more of a player in the world market, we may well see the market pricing in more volatility for that window as we go forward. But for now, what can we take from this? It's a period of exceptional calmness in the market from an options pricing perspective. In all probability, the next window of uncertainty, as you might expect, is going to be South America. And we can watch or expect volatility and uncertainty to nudge higher going into that window. Of course, this has implications for us as risk managers in terms of where we lean our risk management decisions towards. We always have a few potential avenues available to us, whether it's simple futures, physical market, options, or the OTC market. And volatility plays an important role in that decision making. For now, I hope that this is some way helpful. We certainly enjoyed doing this analysis for you all. And if you have any questions, as usual, please reach out to us at our email addresses or any of our offices around the world. Thank you very much, and we look forward to seeing you all soon. Goodbye.